Good afternoon and welcome to another episode of Real Estate Recess. It is February 27th, 2025. I'm going to take a quick peek out this window next to me here, and I can tell you that our spring teaser is here. This is that thing where at the end of every February, it seems like we have this moment in time where we feel like winter is coming to an end and we might have some reprieve from our typical gray and rain. So I don't know how long it will last. It might only be a couple days, but we will take it. We will take it. So on today's episode, you just get me today. No special guests, but have some topics I'm excited to share with you today. First of all, we're going to talk about the lock-in effect. What's the lock-in effect? We'll break it down, but it has to do with low interest rates. And in addition to that, we're going to be talking about how you can leverage buying a home without selling your first one. Let's say you're one of those people that has a low rate. What are some solutions and ways to make that transition easier for you? The second thing that we're going to talk about is the conspiracy theory, or is it such a conspiracy theory, about Blackstone's purchase of hundreds of thousands of residential units across the United States and what that actually means for the real estate world that you and I navigate, me as an agent and you as a consumer, every single day. And finally, let's talk about just some things, some practicalities about the spring market and what you should be getting ready for if you are gearing up to make a purchase or to sell a property this spring. So we'll just talk about a handful of things there to end everything. But in the meantime, would you leave me a comment today? Because it's sunny, it's iced coffee. I usually start making the paradigm shift around this time of year to an iced coffee. So comment, let me know if you are ready to make the switch to iced drinks or if you are still hanging on to the warm drink bandwagon. But otherwise, without further ado, since you just got me today and no other pleasantries, let's just get into it. So the first thing we wanted to talk about today was this article here. And if you want to view this, I'm going to link this particular post in the comments so you can come back to it. So, and I thought this would be interesting to bring up as we're coming into here in Oregon, our spring buying season. Technically, in the real estate world, we like to say that this kicks off around the Super Bowl, which the Super Bowl or the big game, whatever I'm supposed to say, whatever. Once that happens, that traditionally we would say that's when our spring real estate market starts to kick off and things start to get busy. Well, we are effectively past that point and going to start looking at the weather's going to get nicer and people are going to come out of their houses and see the sun and think, gosh, it's time to start gearing up for whatever moves we're going to make. So along with that, how do you buy a home without waiting for lower rates? And there's that lock-in effect I talked about earlier is a pretty interesting phenomenon. And that is basically going back to those historically low rates that we saw through those COVID years, 2020, 2021, and 2022, the early part of the year there. That is when a lot of people refinanced for those historic lows or purchased a property at those historic lows. And I'm just going to tell you right now, I don't have a crystal ball. I wish I did. That would be amazing. But I'd probably be a lot richer if I did. But I can tell you that the odds of us getting back to those low rates, I wouldn't hold your breath and I would not wait for that to happen. We can't predict anything that's going to happen in the economy or the housing market or with interest rates, but to wait and anticipate that they will go back to the 2s or 3s, you may be waiting a very, very, very long time if anything ever changes like that to such a degree. So how does that affect where we're at now? Well, a lot of those people that bought homes or refinanced at those historically low rates, my family being one of those people, that is keeping them in their homes. And that is what we call the lock-in effect. They are locked in. It is so affordable for them to have that rate that they have. It just does not make sense for them to move. And the tricky part with that is a lot of people bought homes that they either absolutely despise. Maybe they bought the house because it felt like the right thing to do because money was cheap and the opportunity was there and the market was frenzied, that they maybe had to sacrifice some things. They didn't get a chance to think things through because houses were literally flying off the shelves. You have people who outgrew their space over the last few years. Perhaps it was a couple that bought a house, maybe their family has grown, and now they're in a 2-bedroom condo, and that doesn't fit their needs as their family continues to grow. If you've got a dog and you've got kids and you've got space constraints, that gets to be really uncomfortable. And that affordability equation starts to be weighed differently in your head. Or how long can you remain uncomfortable in that position? And you've also got the interesting thing with this is just my theory, is that boomers are going to be staying in their homes longer than we thought also, because perhaps they refinanced, pulled some equity. It's still affordable for them to live in a home that's probably, maybe it's too big for them. Maybe they should right size to a property that suits their needs, the stage of life that they're in. We've been talking about in the past this thing called the silver tsunami, where the idea being that boomers are going to suddenly just sell all of their larger houses and flood the market with this inventory of properties as they downsize, which then creates some inventory challenges with people who would be buying homes that could also be suited for beginning intro to the market buyers, those first-time home buyers, like those 3-bedroom, 2-bath, 1,400 square foot ranch homes. Suddenly the demand is, you're fighting boomers for those types of houses. That's the theory behind this silver tsunami. We haven't, I wouldn't say we've seen that. Actually, I've seen a lot more folks in the boomer generation deciding to age in place or retrofit their current homes to fit their needs in this time with whatever accessibility things they may need as they age in place. So who knows what's going to happen there? But all of that can somehow, in my opinion, be tied to the lock-in effect, and why it is that we just don't seem to have the inventory on the market that we might like to see. There's just not a lot of properties to choose from. And that creates that economic situation, right, of supply and demand. When there's not enough of something on the market and there's still a hearty demand for it, that means prices are going to, if they don't continue to go up, they're going to stay where they're at, or they're going to gradually increase. Unless some other economic forces come into play, we are not going to, in my opinion, based on the data I've seen, going to see prices just plummet. I just don't see the makings of a real estate crash from any of the data that in the realities of the market we're in right now. So let's take a deeper look at this. Let's say, okay, so you are one of these people where you feel like you have the old golden handcuffs of the lock-in effect, where you've got a low rate, your payment's comfortable, you can make it work, it fits your family budget, things are looking good. The only thing that doesn't fit your family anymore or your individual situation is the house. It is not working. It is not a right fit anymore, and it's time to do something different. How on earth can you make something happen where you can feel comfortable and confident with this? So this article here, How to Buy a Home Without Waiting for Lower Rates, is breaking this down. So, but first of all, how much will rates drop? You may remember, maybe if you follow the real estate world, and if you don't, that's okay. In 2024, I remember from January to December, I kept hearing people predicting we are going to hit 5 by the end of 2024. And guess what happened? We didn't. We did not hit 5. There was no handle. There was no rate with a handle of a 5 in front of it. Much to a lot of people's disappointment. A lot of crow was probably eaten or not. Maybe those people just deleted their posts. It's dangerous to make predictions about where rates will be because we just don't know. There's so many things that impact interest rates and what happens with them. So how much will rates drop? Well, these predictions, and I would just take them as that. I would not take them as the word, and this is exactly what's going to happen because we just don't know. What I think we will see, and I think that this is a modest expectation here of what Fannie Mae and the Mortgage Bankers Association is talking about, is that we will stabilize at around 6.5. I think that is right in line. That makes sense to me. I think that if we see stability, going to 6.5% is going to be a tremendous thing for consumers in the market. If that's folks like you, who want to make a purchase, want to make a move, but you keep seeing these wild swings in the interest rates, and that's just kind of got you just you don't have the confidence that you might like to have. So you just sit on the fence and wait. I think if we see a stabilization of interest rates at around 6.5%, that is going to be a huge win. At least people, consumers, folks like you out there who are watching the market are going to say, okay, I know what I can plan for. 6.5. We know this is about what it is. We know what we're kind of walking into here. And you have some confidence. Confidence is key here. So the projections by Fannie, MBA, Wells Fargo, and the average is right here by the fourth quarter of 2025 coming in at around 6.5%. So I don't know. What do you think? You leave me a comment. Let me know in the comments if you think we will hit 6.5% or what you think is going to happen there. So then we continue on. How do you buy a home in today's market without having to wait for those rates to drop? There are options, and I will just say this, my caveat and my disclaimer with all of this is I am not a mortgage lender or a mortgage expert. If you need somebody, you want to bounce these ideas off, you want to talk about situations, I'm happy to refer you to excellent professionals in that particular field. However, I can give you a high-level breakdown, and that is what we're going to do here. Something to kind of give you some ideas, get the thoughts started of how you can navigate this situation of how you buy without waiting for rates to drop, especially if you are challenged by a housing situation, just doesn't fit your needs. So the first one, this is something I've used a lot with my buyer clients and with listings. I've seen clients, buyers coming to buy the property, ask sellers for help with this, and that is a mortgage buy down. So that is something that allows the buyer to pay an upfront fee or a fee that is paid upfront to lower that mortgage rate for a period of time. That period of time could be short term, like something called a 3-2-1 buy down. It could also be a period of time, meaning the life of the loan. You can do a permanent interest rate buy down on the life of the loan. So your interest rate will forever be at that rate you bought it to. So the thing with any of these is, especially a 3-2-1, which is more of a temporary situation, you have to qualify for the mortgage at the full price. And then it's a stepped up, a graduated way of getting up to that full payment amount. Some people, that makes them uncomfortable, and I can understand why. It's life circumstances and the way that life goes sometimes. Putting that change into the mix, it may not be the right fit for everybody, and that's okay. If people are going to do that, my advice to you as an advisor in these situations is to take whatever that savings is that you have every single month from using that temporary buy down, either set it aside in a separate savings account or apply it to the principal of the loan balance. So by the time you get to that end of that term where you have that temporary buy down, you have some savings or you've paid off the principal. Either way, whatever's going to work for your situation is a great idea, in my opinion, if you're going to use those types of products. Again, this is not financial advice. You need to talk to your accountant, to your financial advisor, and figure out if this is the right fit. But just some ideas, some things to think about. And as a seller, I would say be prepared. If you're listing your home for sale, these buyers are going to be coming to you and asking for closing costs, money towards that they're going to use towards these interest rate buy downs. It's going to make it easier for them to buy your property. So I would absolutely consider that as you're thinking about your home sale. So adjustable rate mortgages, those have a little bit of a stigma to them, do they not? If anybody remembers the good old market crash back in 2008, 2009, there were a lot of these mortgage products out there. And they kind of have gotten a very bad reputation over the last decade or so since these were last really in favor. They've, for the most part, gone through and have changed. The products are different. As this quote here says, ARM products are different today from many of the products in the mid-2000s. So before 2008, lenders often approved ARMs based on borrowers' ability to pay the initial lower rates. And sometimes they didn't even check that. But today, adjustable rate borrowers qualify based on their ability to cover a higher monthly payment, not just the initial lower payment. Also, things have changed in the mortgage world a ton since the crash happened. The underwriting standards and practices, which is the I'm going to call it like a forensic investigation of your finances by the mortgage company, is so much more in-depth and robust than anything we saw back in 2008 or 2009. We go back then, it was, and I'm telling you this as somebody who we bought our first house in January of 2007. Well, it closed in February of 2007. So we literally bought our first house just before all this went down, the crash happened. And having gone through that, I remember it was not the robust financial check that happened in 2016 when we then bought our second house. So a lot has changed. They really do a deep dive into a financial picture for a buyer. So there's that. And then the redesign of this program, they're looking at it from the position of the borrower has to qualify and at the highest payment possibility, rather than just saying, well, they can cover the lowest payment. Again, this is not an option that works for everybody, but it could be an option for your situation. So I definitely suggest looking at that. Another option this article gives is the assumable mortgages. I had a listing last year where the seller happened to have a loan that you could assume. It was an FHA loan at, I want to say it was a 2.875 interest rate or something like that. And that was a tremendous win for the people who ended up buying that house. When you assume a mortgage, here's how that's going to work. You have to, so the sale price, let's say it's $500,000. And then the seller has a remaining balance of $300,000 on their mortgage. That means you have to bring the difference between the mortgage balance and the sale price to the table. So that would be, if it's a balance of 300 and a sales price of 500,000, you have to bring $200,000 in cash to the table. If you have the kind of resources to be able to do that, it's going to pan out over the course of the life of the loan, over the time, especially if you're getting into something that is at one of those historically low rates. The thing to consider with it is, however, that these assumable loans often take quite a while to close. They can take anywhere from 90 to 120 days. So it is not something that you want to jump into if you have a time frame that you must be in a house, you must close on a house, and you have a time crunch. It is a longer term play, and it is kind of hurry up and wait and sit around and wait. The banks that do these assumptions for their loan, they tend to not prioritize them because it's not a new loan. They're not making more money off of the transfer of this loan. So again, it takes longer. It's a different process in a different department. So again, it's not the right fit for everybody. So those are the three options that this article gives you. Another option that I thought of that could make sense is a bridge loan. And that's a loan that's temporary that enables you to purchase a property before selling the house that you're in. Some people have some anxiety or reservation about putting their house on the market and selling it before they have a place to go, which makes sense. I can completely understand why. So this particular product could be an option. It's not something that is listed on here, but something else to think about. So anyway, there you have it. There are some ideas as to how you can purchase a property without waiting for those mortgage rates to drop. But I want to know what you think. Do any of these options make sense to you? Leave me a comment. Any other thoughts or questions, leave me a comment. Would love to hear from you and have you be part of this conversation. All right. Topic number 2, let's talk about it. Conspiracy theorists out there, raise your hand. If you're a conspiracy theorist, give me a thumbs up or something in the comments. I'd love to know. Conspiracy theories are kind of fun. They're kind of interesting to think about. And in today's world, can we just agree on one thing? There's no shortage of conspiracy theories. If you go onto TikTok, sometimes you'll fall into a rabbit hole or the algorithm will just send you all these conspiracies. I don't know what it is, but somehow I get served things about UFOs and like weird stuff, and then I get sucked into it. I don't know why. It's weird and oddly fascinating to me. So anyway, conspiracy theories in the real estate world is not without its own set of conspiracy theories. And one of them that continues to make the rounds has to do with institutional investors and buyers purchasing residential properties. You got it. I'm talking about Blackstone, and the idea that they are buying up all the homes in the United States, and the whole idea of you will own nothing and you will like it. We will be a renter society. You won't even own a car. There's all of these conspiracies. And so what I would like to say is what we're going to talk about is not a discussion of right or wrong. It's just different viewpoints, what we're actually seeing, what does the data actually say? And again, like any piece of data, there's limitations to it. There's all sorts of things that we could say about it. So let's take a look at this article here. This was interesting. This is another one I will link in the comments down below. So come back and check that out. I'll do that here when we're done. But are investors actually buying up all the homes? All the homes. This is a current article. This is not something going back, but this is from just this week, February 25th. So a common thing and a common discussion point I'm seeing fairly often with people who want to buy a property is that they feel downtrodden. They feel like they're trying to buy, but they're up against these Wall Street investors, as this article says, that they're going out, they're paying cash, they've got deep pockets, they're able to just say, here's $100,000 over ask. Sorry, you individual single family buyer with an FHA loan or whatever, like tough luck, like you're up a creek now. So there's this belief that these mega investors are out there, they're driving up prices, they're buying up all the houses, and that is making it increasingly difficult for individual and regular buyers who just want to buy a house for themselves or their family, for those folks to be able to compete in the market today. But is there truth in that? Is it truly every single situation where we see institutional buyers coming in? Is it regional? Do we see it here in the Portland, Oregon metro area? Is this an actual thing that's going on? So let's see what this article has to say and the data that surrounds that. And again, this is not a conversation about whether this is right or wrong. These are viewpoints. And I'm certain in other parts of the country, this could be a totally different conversation. So let's just talk about the data by and large, the overarching 10,000 foot view on this. So first point in there that is mentioned in here is that most investors are small and they're not the mega investors. Small investors being the mom and pop type, the older person down the street who rents their 1960s home and they live in a different home around the corner and they just happen to own both and they rent it out because they don't want to sell it and they like to be part of the neighborhood that way. So it is a misconception, according to this article, that massive institutional investors are dominating the market. But according to the mortgage report, there's a quote here that says, on average, small investors account for around 18% of the market, while mega investors represent only about 1%. So it's a pretty small amount of the market. And what they're saying is that these investors are truly the mom and pop type investors who own a handful of properties, but they're not like the large corporations who say, we're going to buy this whole entire block of a neighborhood and just buy it out. So anyway, there's that point. Investor home purchases are dropping. So here's some interesting data as well. So you hear about all these big investors in the news, but it seems like if we look at this chart here, it's alluding to the fact that these institutional investors, those same ones you're hearing about on the news, have pulled back and they're not buying as many homes. So this article or this data here in this graph is according to John Burns Research and Consulting. And the peak for those institutional buyers, those big investors that gobbled up everything, was peaked in the third quarter of 2021 and Q3 of 21 and Q3 of 22 were the highest two quarters where this was the case. So in Q3 of 21, it was around 2.2% and 1.7% in Q3 of 2022. And so, and I think about this too, that was the number of transactions, sales that happened in the real estate world during that exact time frame is bananas. All right. That is when we had experienced those historically low interest rates. Everybody was clamoring to get a low rate to buy the property. It was a point in time where you could, because the rates were low, you could buy a lot more house than you would be able to buy today. So people were scrambling to get these houses. It was super competitive, and we did a crazy number of transactions. So a lot of sales happened during that time. And rates were low. Remember that. Rates were low. Do you think that individual consumers were the only ones taking advantage of cheap money? They weren't. I would bet a nickel, at least a nickel, a single nickel, that these mega investors or these companies that were coming in to buy properties, they were also taking advantage of the fact that money was inexpensive to borrow, and they were using that to purchase these properties. I bet that I would my theory, my feeling about this is not verified, is that they would have absolutely have taken advantage of that, just like anybody else would. So the shift has happened, and you compare that to the third quarter of 2024, 0.3% of the share of homes purchased was 0.3% by institutional investors in the third quarter of 2024. So obviously, there's a lot of reasons why in 2024 and why this trend shifted so dramatically between 2022 and 2024. Interest rates. There's a lot of economic challenges that we have been experiencing over the last couple of years since interest rates, and we've been dealing with inflation and the cost of things. It's hit everywhere, including these institutional investors. That would be my idea. And it says it in here too. So again, this article is saying the idea that Wall Street investors are buying up all the homes, they're saying it's a myth, basically. And there are investors in the market. They're not nearly as active as they were in the past years. So that's interesting. So there's that. Let's take a look at another article, which I thought was pretty interesting. And this is, let me make sure I have the right one here. Yes. Okay. This article here. Now remember, it's not BlackRock. We're talking Blackstone. Maybe BlackRock, but we won't talk about BlackRock today. We're talking about Blackstone. That is what we're alluding to here. So this is an article from a little over a year ago, but it came from a time when Blackstone was working on completing an acquisition or purchase or merging with this Tricon Residential. And so this is giving some numbers going back a year. So certainly these numbers have shifted, but here's the reason I wanted to include this is because it shows just how many homes were owned by these entities as of this point in time last year. So it's interesting to see what is the actual volume. So what it says here is that if we come down here, Parcel Labs, which is the homes owned by Tricon and Home Partners of America. So Home Partners of America is also owned by Blackstone. Filtered for markets with at least 200 single-family homes owned. So what are the metro markets in the United States where Blackstone actually owns a lot of these properties? So if we look here, we've got this is ranked from highest to lowest. So the top of this list is Atlanta, Georgia. So it's definitely not the Portland, Oregon metro region. Tricon owns 7,100 homes, at least at this point in time last year. And Home Partners of America owns over 4,000 homes in Atlanta. And from there, you can see the different markets, the top markets where this has happened. And then we scroll down. Is Portland, Oregon on this list? Yes, it is. It's down here underneath Riverside, San Bernardino, Ontario, California. And it is 385 homes in the Portland metro area are owned by Home Partners of America. There's nothing owned here by Tricon. So a pretty small piece, if you look at the number of properties in the market that are available or that are out there, 385 properties is a very small amount to be owned by technically with connection to Blackstone of any kind. So it's pretty interesting. So again, Portland, Oregon Metro doesn't even hit the top 5 of this data that is according to this Parcel Labs. So then this point in here that's highlighted in purple, it says while a portfolio, so nationwide between the two, Tricon and Home Partners of America, the portfolio of properties they own nationwide is, let's just call it just under 62,000 homes as of January of last year. isn't small. Nobody would argue that's a minuscule amount of properties. But if you look at the overall housing market, it's really not a big thought. In the United States, it says there are over 82 million single family homes. So 61,964 is a drop in the proverbial bucket of 82 million total single family homes in the United States. Again, it is not a small amount, but on a day in, day out basis, it is challenging when, as a buyer, you're faced with something where you're going in to make a purchase on a home you fell in love with, and it is a competitive situation, only to find out that you lost out to an institutional buyer buying in your area. You just want to buy a home for you or for your family, for your situation, and you fell in love with it. Your kids pick out their rooms, all that kind of stuff. That's heartbreaking, and it's hard, and it certainly is. It's very disappointing and frustrating, especially when I know how hard people work for their money. So, but the data, I mean, this is one piece of data that says that this portfolio is truly a drop in the bucket of 82 million single family homes in the United States. So, and then it goes on to say, on a national level, institutional home buyers, so firms owning at least 1,000 homes, own 1% of the total U.S. single family stock. And that's also according to Parcel Labs. So again, this article, I will link it in the comments below. Please do come back and check it out if this is something you want to see and refer back to. So I want to know what you think. What are your thoughts? Leave me a comment. Do you think that this data is accurate? What's the grander conspiracy is that secretly these institutional investors are buying up all the housing stock in the United States. According to this data, now again, this is not debating right or wrong. It is what it is. They own just under 62,000 properties as of the writing of that article in January of last year. It's pretty much a drop in the bucket in the U.S. housing inventory. But what do you think? I want to know, let me know what your thoughts are. And that's not to say there's not other smaller scale institutional investors that you might be competing against in the real estate market in the United States. All right. Where else do we go from here? The final thing I wanted to talk to you about. The weather is beautiful. The sun is out. We have our spring teaser here at the end of February. It's going to be March in a couple days, which is utterly crazy to believe. So let's say you're a consumer and you're thinking about, you've got a house that you want to sell and you're ready to make a move. What do you do now? Are you behind? No, you're not behind. But here's what you need to think about. Give yourself 6 to 8 weeks of pure solid prep. Now is the time to meet with an agent and start making your plan. And that plan would be meeting now, talking about the ins and outs. What improvements do you need to make? What should you plan for? What are your steps? What are you planning to do after it closes and after you sell? Are you buying another property? Are you just selling it off and whatever? Make a plan. We don't want you to be homeless or without a plan. So planning for that now. No, you are not behind. If you want to hit the spring market, I think in the peak and where things are going to be good, now is actually the best time to do that. If you're a buyer and you're wanting to buy, please do the following. A, talk to your realtor that you know, like, and trust. I am one of those people. I hope you can know, like, and trust. You can get to know me. You can follow me on social and Instagram. You can give me a call and we can chat. You can see if I'd be a good fit. But anybody out there that you'd work with that you know, like, and trust that can help you navigate this is coming up with a plan. Everybody needs a plan, whether you're a buyer or seller, but especially if you're a buyer, because there's some aspects of this that you're going to want to have handled before you actually start visiting houses. In the state of Oregon, well, I already said you're going to want to talk to your realtor, because also in the state of Oregon, in order for an agent to represent you, you're going to have to sign something called a buyer representation agreement. That just outlines the details for you as a consumer and for your agent on what are the expectations and the accountability for both people, you and your agent involved in this transaction, how your agent is paid, who is going to pay, how the amount that you're responsible for paying your agent, how long it's for. Are you going to test the waters with an agent for a week, or is it going to be a 6-month process? Those are all things that you're going to want to determine when you interview your agent. Don't be afraid to ask questions. How many properties have you sold in the past year? What I'd like to see some reviews. Where are your Google reviews? Can I check out your website? What's your social media presence like? Just to see what's going on. It's a fun fact that around 74% of real estate agents in the United States didn't sell a home last year. So make sure you're asking questions about the agent that you're working with and see what their production history is like. B, let's move on to B. B, talk to a mortgage advisor, somebody who can assist you with what are your options on a financial standpoint. If you don't know somebody, your realtor, your agent that you want to work with can refer you to some great people. I have some excellent mortgage loan folks that I work with who I trust. I don't get kickbacks for that. That would be highly illegal and unethical. But the only thing I love about these relationships, is I know these people are going to take care of you. They're going to do the right thing. And that's enough. That's enough for me. I have that rapport with them. I know the job's going to get done well. So talk to that lender, because they are going to give you advice on the types of loan products that will work for you, and they can assist with the financial piece of that equation. Once you're pre-approved, that is leading to the C, A, B, and C step on our list, is then you can start looking at properties. I do not recommend seeing properties before you're pre-approved. You may not like to hear that. But here's why. You're going to go into an $800,000 house because it's beautiful, thinking, oh yeah, I can afford that because Zillow's mortgage calculator said I could afford it. Great. So then you go and see this house, you fall in love with it, come to find out you're only pre-approved for $500,000. You're heartbroken because your expectation is for $800,000. What are you going to find that's $500,000 that is also like an $800,000 house? Don't do that. Don't make that mistake. Or also not get pre-approved, fall in love with the house only to realize you're behind and it's a competitive situation. That is still happening today. We're still seeing multiple offers. The last thing you want is to fall in love with a property and then be able to do nothing about it because it flies off the market faster than you're prepared to move. Pre-approval is never a bad idea. It is always a good idea. Definitely take that step. So A, B, C. A, talk to a realtor. B, talk to a lender. C, start looking at houses and go from there. So those are the things. And yes, those processes, buyers might take 30 days. Your lender might take a look at your situation and say, if you give this 3, 6, whatever, many months, if you pay this off, if you save up some extra cash, blah, 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 they might have some steps for you to take that would put you in a better position to get more of what you need or want in your purchase. So take their advice. It might take a little bit longer. You may not like to hear that, but it could be what's ultimately best for you at the end of the day. And also, as another asterisk or fun fact about all this, you may look at this and it might feel daunting and overly expensive, and it may not make sense for you. Maybe you're in a property that's a rental that you pay a decent, like an affordable rent on, and it currently works for you, and it can work for you for another 6 months or 8 months or a year. And then moving up into a purchase of your own property then becomes cost prohibitive. You start to feel anxious about that amount and what that's going to do for your bank account, for your lifestyle. First of all, there's no shame in renting. Do not be ashamed of renting a property if that is what works for you. You need a safe place to live. So does everybody. So don't feel any shame about that. And also, it's okay to wait. It is not the right time to buy for everybody. I have, yes, worked with first-time buyers recently. Some of those folks were able to receive gifts from family, and that greatly helped them. A lot of buyers I worked with last year were not first-time buyers, or they were more established in their purchase or in their financials, where it was different. It was a lot easier for them. Everybody's situation is different, and it is okay to hit the pause button and wait for a time when it does make sense, because no, it is not the perfect time to buy at any time. There are pros and cons to buying now, 100%. And that's where talking to a good realtor is going to give you those pros and cons for your market and for your situation. So anyway, I hope that was helpful. Leave me a comment and let me know what you think about anything. Why is the sky blue? What's the best iced coffee flavor? Anything, leave me a comment. Love to have you be part of this conversation. But otherwise, I think that about does it for today. That covers our time today here on Real Estate Recess. And again, as a reminder, I'm live every Thursday here at Living in Portland Suburbs, my YouTube channel. I'm live on Facebook, LinkedIn, and Instagram. So definitely come and check that out. Join the conversation. Sometimes I have fun guests that add some life and color so you don't just hear me blah, blah all the time. So anyway, but again, I'm Jennifer Schurter. I am your local real estate expert here in Canby, North Willamette Valley, Clackamas County, really the Portland, Oregon metro suburbs and south. And if you're looking to make a move around these parts, I would love to be of assistance and be able to advise you through that. And in the meantime, I will see you next week. Have a great day and enjoy our spring teaser while we've got it.